FedEx just kicked off fourth quarter earnings season, and instead of telling us that the global economy was bottoming out and turning around, they did something very unexpected. They normally post full year guidance. This time they cut it back just to the recent quarter, and what they said is they're facing a major problem, something other businesses are facing as well, and that is the fact that demand is plunging at a faster rate than they can cut expenses. And if things don't turn around and quickly, particularly with the trade war, what FedEx said the decision they're going to be facing and a lot of other companies are going to be facing as well could plunge the entire world into a recession. We'd like to welcome back Resolve AI as our sponsor for today's show. You can find them on the NASDAQ under the symbol RZLV. And you may remember we featured them back on Sunday. And since then, we've got a ton of messages and comments about the company. And then on Tuesday, they had a major announcement and the stock went vertical. Now, if you're a technical trader or an Elliott Wave trader, you can still catch the next wave. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now, let's find out why FedEx is warning that if things don't change in the global economy, that things are going to get much worse, perhaps even pushing us right into a recession. And FedEx noted in its earnings that it would only share its outlook for the current quarter due to the, quote, uncertain global demand environment. The forecast assumes no further negative developments in the global trade environment, indicating that if things get worse, FedEx is facing a major problem, and that is demand is collapsing at a faster rate than they can cut expenses. And this is an issue not just for FedEx, but for companies all over the country and the world. And the issue they're facing that if they can't cut expenses fast enough, they're going to have to cut employees. And for the equity markets, well, this is a major red flag because the shipping giant stock was down 18% in 2025 through Tuesday's close, down even more after the open, while the S&P 500 index rose modestly over the span. And again, FedEx is a major bellwether of the economy and the stock market. If you want to know if the economy is expanding and turning around, well, you look at the shipping and transportation sector. If things are getting worse, you're going to find it in companies like FedEx. But as far as the market goes, well, check out this chart because this is a real red flag. Because if you look at the relationship between the S&P 500 shown in purple and FedEx shown in the red and green, what you can see is there's a very strong relationship. You can see when FedEx goes up, the market follows, and when FedEx goes down, well, the market tends to go with it. And there are times when the market is down and FedEx is up, and one of them will have a mean reversion. Now, the problem we're facing right now is FedEx stock is down and had a brief rally and is now looking to roll over and head lower. Meanwhile, the S&P 500 is roaring up towards its all-time high, looking to potentially make a double top. But if FedEx continues its downward trend, it's an ominous sign for the S&P 500 and the economy, telling us that the likely path of the stock market will follow where FedEx goes. And U.S.-China shipments, the company's most profitable trade route, quote, deteriorated sharply, meaning planes are flying back empty. And in May, volumes are expected to remain under pressure, suggesting that there's absolutely no change in the global outlook. Now, we already know that companies have cut back on their imports due to the tariffs. And again, this is an issue for FedEx because what they're facing is having to idle airplanes and cut back on hours and staffing. So we've talked about the importance of global trade and the global labor market, and now you're seeing in real time FedEx is saying very clearly, if this trade war doesn't end soon and we see demand pick back up, what we're going to be faced doing is something a lot of other companies are going to be faced with. And for the broad U.S. labor market, well, it means what we're headed into is likely a massive recession. And analysts have already reduced their 2026 profit estimates for FedEx in the recent months, worried that weakening consumer confidence and soft industrial demand would overshadow the company's efforts to slash costs and revamp its delivery network. And so FedEx was already starting to cut costs years before. The problem right now is the global economy is falling at a faster rate. And again, you talk about the major effects we're facing in the economy here. It's not just the trade war. Remember, the economy is already slowing down before that happened. Then we had the impact of the conflict between Iran and Israel that drove energy prices up. And all this is doing is impacting consumers' ability to spend. At the same time, confidence is plunging. We know spending goes with it. And for companies like FedEx, what they're saying is, unless things change and fast, they're going to get a whole lot worse. But something that is screaming higher, that is the stock for our sponsor of today's show, Resolve AI. You can find them on the NASDAQ under symbol RZLV. Let's go back to Sunday when we featured them on the show. You can see the stock the very next day hung on to its 50-day moving average, and then on Tuesday on the big news, the stock shot straight up. Now, if you're an Elliott wave trader, what you see is it makes moves in waves. You can see the first wave jumping up here. It looked like it already has pulled back into a previous supply zone today, looking to make another big move higher. Again, this is a company a lot of people are talking about. We've never seen more interest in any company we sponsored on our show. Stay tuned to the end of the show or check out the pinned comment or description for more information. But now let's turn to General Mills, who is saying the same exact thing that FedEx is. Demand is down, consumers are changing their spending habits, and again, if things don't change in a major way, they're also going to be facing the same decision as FedEx, and that is mass layoffs. Given the uncertainty, the company expects shoppers to continue seeking value, and that means they're trading down in a major way. In addition to budget-conscious consumers, the U.S. largest food companies are facing a number of other challenges, including the continued loss of market share to lower-cost private label brands. And this is something we heard from Kroger recently that said they're seeing a boom in private label brands because consumers are looking to save any amount of money in any way they can. They know the economy is getting worse, and this is exactly what FedEx is telling us as we kick off earnings season. And even if we see earnings look fairly decent this quarter, well, FedEx is telling you very clearly right now, if something doesn't change, the following quarters are going to be even worse. And that's why we looked at that chart between FedEx and the S&P 500, because if things don't change, we could be facing an all-out bear market. Let's take a look at the University of Consumer Sentiment survey shown in red against the Consumer Price Index shown in blue. And you can see what happens when prices go up. Consumers lose confidence. And it's, again, all about their paychecks. And we can see this happen going into every recession. It's a rise in inflation and a lack of spending power to afford it that leads to a decline in confidence. When that happens, you see consumers trading down to store brands. You see them demanding fewer goods. You see them not spending money on overnight shipping. And next thing you know, you run the risk of a slowdown, even worse, an all-out recession. And right now you can see that consumer confidence is at one of its lowest level in decades. Not only does that mean that consumer prices are likely to come down, but if you look at FedEx's situation, you're talking about him having to idle airplanes, cut back on routes and hours and jobs. It's going to affect the broad economy. You look at General Mills, well, what are they facing? Well, they're losing market share in a big way. In fact, their only answer is to cut costs. But it's substituting ingredients and reformulating products to limit the impact. And it wasn't long ago that companies said, look, we're not going to absorb the tariff increases. We're going to pass it on to consumers. We said, look, consumers can't afford higher prices. They're going to cut their spending. Now what are we finding out from companies like General Mills? They're having to do anything they can to keep any price increase at bay. FedEx doesn't have that option. They can't swap out ingredients. They certainly can cut back their service, the number of flights. They can cut back the number of trucks, they can cut back workers, but they can't change their base product. So again, companies are facing a massive issue here. Demand is going down at a faster rate than they can cut costs. It's only a matter of time before they cut heads. Let's take a look at why consumers can't afford higher prices. It has everything to do with incomes. Now let's overlay the Consumer Price Index with average weekly hours of production of non-supervisory employees. And we can see going into every recession, the same thing happens. Inflation goes up, but wage growth doesn't keep pace. Hours worked starts to plateau and head lower. And next thing you know, you're right in a recession. And based on the relationship between the University of Michigan Consumer Sentiment Survey and average weekly hours, what it's suggesting is employers are about to cut hours in a major way. The issue isn't going to be inflation. The issue is going to be the fact that demand is falling at a faster rate than companies can cut expenses. It means they're going to go into survival mode. And again, they're going to be forced with having to cut jobs in a major way. And let's take a look at the relationship between the NASDAQ 100 and average weekly hours of production and non-supervisory employees. And you can see as incomes go down, the market goes with it as people not only can't afford to invest, but have to cash in money to pay their bills. What we're facing now is a further decline in weekly hours, likely leading the stock market lower, which is exactly what the chart of FedEx is suggesting, that the global economy isn't turning around, that things aren't getting any better. And if you want to look at the pressure this is putting on the Trump administration, well, it's huge. Because Trump is up against a self-imposed July 4th target to pass his tax and spending bill, and he's 2 weeks out from the July 9th expiration of the global tariff pause that concussed the economy in April when he first introduced a raft of levies. So if you look at the U.S. economy right now and the global economy, we desperately need to see something change, and President Trump knows this. He knows he needs to get this tax package passed and soon, and that will take a lot of anxiety off of consumers' minds. But at the same time, he needs to put an end to the trade war. And the problem is FedEx is suggesting, look, if this continues on for any reasonable length of time, the problem is it'll be too little too late if it does change. And the key to the near-term outlook is not U.S. tariffs or the Iran war, but their geopolitical interplay. This year's twin shocks make a global recession look increasingly likely, and this is a case that I've been making for a while now, that the economy was already slowing down and it only needed something to nudge it over the edge. And was it going to be the trade war, or maybe the Iran conflict, or perhaps it was going to be student loans going into delinquency, or maybe it was going to be commercial real estate or something else. But the problem is, based on what we're seeing from FedEx and General Mills and a lot of other companies, that everything is going the wrong way here. Now, maybe if we do get the tax package passed, maybe if the trade war ends, things will turn around. The problem that I fear is already we're at a trajectory that we cannot change, at least not very quickly. But while Trump is running out of time for the economy, it would be a huge boost if the Federal Reserve stepped in and said they were going to cut rates. Now, we know that monetary policy doesn't have an immediate impact on the economy, but it has a massive psychological impact. Could you imagine how businesses and consumers would feel right now if the Fed said we're going to come out and cut rates, but instead Powell says, no, we're not going to do that at all? And Chair Jerome Powell told lawmakers in Congress that the U.S. Central Bank is not in a rush to lower rates, as he and his colleagues wait to see how the economy responds to various new policies, including tariffs. But it's very clear, and this is what's great about FedEx kicking off earnings season, is because if consumers were able to absorb the tariffs and demand was coming back, FedEx would say it. Instead, they said, look, demand is crashing at a rapid rate. General Mills says, look, we're seeing demand go down as people switch to store brands. And so while the Fed is on a wait-and-see hold period here, what we're finding out is the U.S. economy is deteriorating at a rapid rate. And now this is impacting the housing market as sales of new single-family homes decreased 13.7% to 623,000 annualized rate last month, a 7-month low. And that was below all estimates because everybody's saying that the housing market was going to remain resilient. We said that's highly unlikely. As people get worried about their jobs and their income, they stop spending on homes. The latest results show home builders are sitting on rising inventories amid mounting economic challenges, including mortgage rates stuck near 7%, higher material costs due to tariffs, and a slowing labor market. And yet builders are offering subsidies to reduce customers' financing costs. The concessions are yielding diminishing returns and encouraging many builders to slow construction. And again, this is exactly the opposite of what the economy needs, because when builders slow construction, the demand for labor goes down with it. Here you can see the impact the labor market has on housing as we now overlay new privately owned housing units start in blue against average weekly hours of production non-supervisory employees in red. And we can see very clearly as hours go down and paychecks shrink, people want to spend less. They don't want to buy a new home. And right now workers are signaling that hours are about to drop even more. But what we're hearing from FedEx, General Mills, and now home builders is they're not going to need workers as much. And that means the unemployment line's about to get lot longer. Let's take a look at continued claims, and you can see when housing starts go down, people lose their job, and because it's broad-based, they don't have an opportunity to re-enter the workforce. And you can see throughout every cycle, as housing starts to dip, it hits the labor market, and if the labor market starts to spiral out of control where there isn't enough jobs, well, what it means is we're headed right into the recession that FedEx is warning us about. And as you can see now from where we started the show, FedEx isn't telling us that the economy is turning around. What they're telling us, it's about to get much worse. But something we are bullish on, that is the stock for our sponsor for today's show, Resolve AI. Again, you can find them on the NASDAQ under symbol RZLV, and we have never seen more interest in a company we featured on our show until we featured Resolve back on Sunday. Let's talk about the opportunity here because they're making waves, and from an investment perspective, it's seen their stock shoot a whole lot higher. Because since Sunday, Resolve's been making major headlines. They just announced the inclusion in the Russell 2000 and 3000 indices after a breakout year. Resolve's brainpower LLM is reshaping digital commerce, and their momentum right now is unstoppable. Resolve's AI secret sauce is in its Gen AI-powered sales engine, which supercharges search, advice, and revenue for retailers. Their cloud-based SaaS model targets big e-commerce platforms and payment providers, offering a scalable B2B2C solution. With a custom-built AI toolkit trained on e-commerce data, they're helping businesses unlock new growth potentials. And big news from June of 2025 is Resolve AI is joining the Russell 2000 and 3000 indices, boosting visibility with over 10 trillion in institutional assets tracking these benchmarks. This follows their 70 million ARR milestone, achieved in just under 2 quarters, with partnerships like Microsoft and Google fueling their path to 100 million by year end. And earlier in June, Resolve AI secured $70 million in annual recurring revenue, months ahead of plan. And with over 50 enterprise clients like Liverpool, Mexico, and KFC, they're proving strong market demand for their AI solutions and are on track to hit 100 million ARR soon. And back in May, Resolve AI partnered with Google Cloud to supercharge their BrainPower LLM. This integration lets retailers deploy AI at an enterprise scale with unmatched speed and security. It's a game changer for global brands looking to transform digital shopping. And behind the success is a stellar team led by Dan Wagner, who took the company public on the NASDAQ back in the 90s. With skyrocketing revenue and top-tier partnerships, Resolve AI is a standout in the AI retail space, offering a compelling market opportunity, which is very clear based on their recent announcement. Let's take a look at that chart again. Again, we feature them back here on Sunday. The stock dipped down into its 50-day moving average, and 2 days later on the major announcement, they're going to be added to the Russell 2000 and 3000. The stock went vertical, breaking out through that heavy level of resistance all the way up through another supply zone before it found sellers. Those sellers have now pulled stock back today, looking to make another move higher. And again, if you're a technical or Elliott wave trader, you can see the wave pattern forming, making the next move even bigger than the last. And Resolve AI is revolutionizing retail with AI backed by massive growth and a world-class team. Visit resolve.com to learn more about this exciting company, and be sure to check them out on the NASDAQ on the symbol RZLV. And as always, with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.